Good morning. My name is Julie Carlson, and I am the Associate Director of the Schumpeter Project on Competition Policy at the Information Technology and Innovation Foundation. I'm muted. Welcome to the latest installment of the ITAF's Dynamic Antitrust Discussion Series. As inflation rates have risen to levels not seen in 40 years, antitrust populists have been quick to lay the blame for this crisis at the doorstep of the supposed increase in corporate concentration. Senator Elizabeth Warren suggests companies are hiding behind claims of increased cost to fatten their profit margins, while economist Hal Singer has said that general inflation can serve as a pretext for a coordinated price hike. This view that corporate concentration is a root cause of inflation has led to calls for more aggressive antitrust enforcement, including from President Biden, who has called on the Federal Trade Commission and the U.S. Department of Agriculture to investigate price increases and anti-consumer behavior in the petroleum and meatpacking industries. However, others have argued that more aggressive antitrust enforcement during this inflationary period could put even more upward pressure on prices. For example, economist Larry Summers has said that policies that attack bigness can easily be inflationary if they prevent the exploitation of economies of scale or limit superstar firms. So this morning, our panel of antitrust and inflation experts will take up the issue of the relationship between inflation and concentration in the US economy. So I'll briefly introduce our panelists, and then we'll dive right into questions. We have Christopher Conlon, who is an assistant professor of economics at the New York University Stern School of Business. Dr. Conlon's research focuses on industrial organization and econometrics. More specifically, his work examines contractual relationships between manufacturers, wholesalers, and retailers. In particular, he has studied the assortment and availability of products, the dynamics of price competition over time, and the interactions between taxes, regulations, and competition among firms. Robert Shapiro is the co-founder and chairman of Sonicon, an economics advisory firm, and is a senior fellow at the McDonough School of Business at Georgetown University. Before founding Sonicon, Dr. Shapiro was Undersecretary of Commerce for Economic Affairs from 1997 to 2001. He also co-founded the Progressive Policy Institute and served as the principal economic advisor to Bill Clinton in his 1992 presidential campaign. Julie Smith is a professor of economics at Lafayette College and an invited member of the H.O. Steckler Research Program on Forecasting, affiliated with the Department of Economics at the George Washington University. Her research in macroeconomics has focused on inflation and the differential effects of monetary policy. Dr. Smith's work has been published in journals such as the Journal of Money, Credit, and Banking, the Journal of Macroeconomics, and the Journal of Forecasting. Before I turn to questions for our panelists, I'd like to make our viewers aware of the option to ask questions of the panel as well. You can ask questions at slido.com using the hashtag ITIF Antitrust. I expect we'll have a robust discussion, but I'll try to leave some time at the end for audience questions. All right, I am really excited to have both macroeconomists and IO economists here today talking to one another. But let's start with the macroeconomics first. So I just want to just a baseline question, what is causing the current period of inflation? So some macroeconomists point to Biden's $1.9 billion COVID stimulus, arguing that it was well more than what was needed to ward off a COVID-induced recession. Others point to supply chain disruptions and labor shortages due to COVID and to the war in Ukraine. So let me start with Julie. How should we think about these different factors? And how are the causes of inflation today the same or different from what we saw in the 1970s?
Sure. Thanks, Julie. I'm excited to be here today as someone who's thought about a lot about inflation over the last 20 years. I just wanted to start with some background to sort of lay the landscape of sort of where we are with inflation right now. As was mentioned previously, current inflation, of course, is the highest we've seen in the last 40 years. This is after the previous decade of when inflation has been around 2%. As people might know, we have two main measures of consumer inflation, right? We have the Consumer Price Index from the Bureau of Labor Statistics and the Personal Consumption Expenditure Price Index, which comes from the Bureau of Economic Analysis. Much of the attention gets focused on the CPI, but the Fed's preferred measure of inflation is the PCE inflation rate. So inflation measured by these two indicators, right, has been about 8.6% for the CPI ending in May of this year over the last year, and 6.3% of the PCE which ended in April. So economists and the Fed and others look at these measures of inflation and look at other measures of inflation called core inflation, which strip out the volatile food and energy components. Food and energy, of course, have been pushing up overall inflation in these past years because those sectors have seen some of the largest price increases, about 10% in food inflation and about 30% in energy inflation over the last year. So if we were to look at these core inflation measures, which remove food and energy, they've been more moderate with core CPI around 6% and then core PCE at about 4.9% over the last year. Of course, both these indicators are still far from 2%, which is the Fed's inflation target. And there are obviously other measures of inflation that both Fed and forecasters look at to sort of round out their inflation picture. So if we think a little bit more about the Fed and their goal, right, as I mentioned before, they have this price stability goal of trying to get PCE headline, including the food and energy components, to about 2%. The Fed announced this target starting only in 2012, so about a little over 10 years ago. But this statement was sort of reaffirmed at the beginning of this year. But this also coincided with a move to a new monetary policy framework, which is sort of important to understand how the Fed has reacted over the last year. So in late August of 2020, the Fed moved to this flexible average inflation targeting framework, which is that the Fed's goal was to hit 2% inflation on average. This would allow them to have periods of below average inflation, like we experienced almost throughout the whole 2010s, which could be then matched by periods of 2% inflation moderately above the 2% target. So obviously the current situation is far from this moderately above 2%. But I also want to emphasize that part of this shift in the framework was to sort of re-emphasize the Fed's other part of the dual mandate, which was to focus on maximum employment as well. So getting into how the US economy has arrived at sort of these very high or moderately high levels of inflation, obviously both supply and demand factors are responsible for the current inflation, and the interaction of supply and demand have played a role. If we think about demand, as was brought up, both the Trump administration and the Biden administration enacted COVID relief packages that sent checks to households to help them weather COVID disruptions that they experienced in 2020 and 2021. These relief checks were obviously spent, but some were saved or used to pay down debts of households. But what they did do was keep disposable income from falling below trend, as it did in the aftermath of the Great Recession. And this is probably, from the Fed's point of view, what they learned a lot from, and the lessons they're taking away from how they reacted during the Great Recession. So what did this do? Well, this ensured that aggregate demand, which is made up mostly of consumer spending, which is about 70% of US GDP, was able to bounce back after we saw very steep declines in April and May of 2020. But we also saw shifts in the consumption patterns of households, right? Households just shifted towards consuming more goods and fewer services due to the contagious nature of COVID. Goods consumption was about 15% above pre-pandemic levels at its peak and is still currently above that level of only about 5% now. Inflation for durable goods had been running close to zero in the pre-pandemic level, But of course, that has risen as people have consumed more durable goods to about 10% over the last year. But it seems to be on the decline again as households and consumers have shifted back towards services as well. There's also been pent-up demand, perhaps, for services, and that may be starting to push up the prices of services as they've risen over 5% in the last year from about an average of 2 or 3% before the pandemic. We also have housing, where we probably all know that we've seen price increases. Again, demand for housing has been very strong as some workers have been able to shift to remote work. Other workers have reevaluated where they want to live or their type of lifestyle. Fed policy, of course, has played a role here. We've had near zero interest rates that has made borrowing quite cheap. Another point I want to make about demand is in particular about the American Rescue Plan. It seems unlikely that it's a large contributor to inflation right now, because in many advanced economies who did not enact large fiscal packages as the US, they've also seen rising inflation rates, and those inflation rates have been well above their inflation targets as well. So a recent study by the San Francisco Fed tries to quantify this and has really said about a third of the inflation, or a third of the rise in the inflation that we've seen, is probably due to demand factors. On the supply side, right, there are two big factors affecting inflation: the COVID pandemic that has been ongoing for the last 2+ years, and obviously then the war in Ukraine that has occurred this year. Both of these have contributed to supply chain and commodity price increases. The pandemic has had worldwide effects on supply chains, right? Lockdowns in China this year and in other countries in previous years have affected the ability to get goods to markets. Producing and transporting goods face major bottlenecks in the US and across the globe. Ports in the US have been backed up, and ships have taken much longer than average to get unloaded and transported to stores. Some of these conditions have been easing recently, and the prices of some goods, such as lumber and steel, have come down from previous highs. Delivery times and order backlogs are also starting to ease. But I think we could all say that these factors have lasted much longer than expected and have contributed to the rise in producer prices. And of course, as producers face higher prices, those at least get partially passed on as higher consumer prices. The labor market has also played a large role, and COVID has had large effects on it. The economy has been recovering jobs over the last 2 years, and average payroll employment this year has increased by about 488,000 jobs per month. The unemployment rate is about 3.6%, which is near its 50-year low. But there is a mismatch in the labor market between labor demand and labor supply. There are about 11.4 million job openings, and this is far above pre-pandemic levels. And yet labor force participation is below its February 2020 level. So these factors have most likely contributed to a tight labor market. And because of that, we have seen some nominal wage growth, especially this last year. Finally, the war in Ukraine and sanctions on Russia have had large effects on commodity prices, in particular food, energy, oil, and metals. These price increases were unexpected. They're especially difficult to deal with because food and energy affect consumers directly every time they go to the grocery store and every time they go to the gas station. They also make up a large share of consumer spending, making up about 25% of their expenditures. These supply issues are not easily addressed, of course, by the Fed, but the expectation is that these supply issues and shocks might ease over the course of this year. But that doesn't mean prices are going to go back to where they were before, but they're likely that we'll see fewer price increases in the near future and prices will level off. So I expect supply chain issues to contribute less to ongoing inflation. So how is this different than the 1970s? Well, first, I want to say that inflation expectations are better anchored than in the 1970s. And this is due to the Fed gaining credibility over the last 4 decades. So what we had in the 70s was a build-up inflation from the late 1960s into the 1970s, which led to ever-increasing inflation expectations. If we look at current inflation expectations by the Survey of Professional Forecasters, which comes out of the Philadelphia Fed, yes, they expect higher inflation this year, around 5%. But they see inflation returning towards the Fed's goal of 2% over the next 2 years. The University of Michigan survey, which got a lot of press right before at the last Federal Open Market Committee meeting, actually shows fairly similar inflation expectations to the Survey of Professional Forecasters over the next year of about 5.3%. For consumers over the next 5 years, they think that inflation will rise by about 3%, which is close to the average over the last decade. So the good news is inflation expectations seem to be anchored in the medium or longer term. The war in Ukraine, as I mentioned before, has affected commodity prices, especially the price of oil. However, these shocks are smaller in real terms than we experienced in the 1970s. The US economy is also less oil intensive than it was during the 1970s. And due to climate change, right, there's an ongoing desire to move away from fossil fuels. Most likely, these disruptions that we experienced from the war in Ukraine have been priced into the oil market. And this may cause oil prices to stabilize and energy prices to stabilize as well. Lastly, the Fed now has a clear mandate for price stability, and they have an explicit inflation target of 2%. Last week, in his testimony to Congress, Powell made an unconditional commitment to lowering inflation. There's greater transparency at the Fed and the central banks worldwide, which allows the public and financial market participants to gain faster and clearer insight into the policies and thinking of Fed policymakers. This mandate for price stability is also necessary for us to achieve growth, economic growth, and maximum employment. However, during the 1970s, we had a monetary policy that was really stop and go and had no real commitment to maintaining lower inflation. Of course, there are risks in its outlook. We can't know for sure that we're not going to have ongoing supply shocks. We can't know that the Fed and other central banks are going to carry through with their commitments to return inflation towards their targets. And of course, if they don't, inflation expectations may become unanchored. Both of these risks mean that monetary policy may need to be more aggressive to return inflation to its target. Lastly, and summing up, really, I am optimistic that the economy can return to a period of low inflation and a strong labor market that's both inclusive and broad-based, as I expect supply shocks to dissipate and the Fed moves away from its very accommodative monetary policy that we've had over the last 2 years. Thank you.
Thanks, Julie. That's really helpful perspective, and I don't know, maybe perhaps gives us some optimism that there's light at the end of the tunnel. So, you know, in sort of poking around at what folks were writing about in the 1970s, you know, I noticed that this question about the relationship between concentration and inflation also came up then, with economists and legal scholars arguing that there's no relationship or perhaps even a negative relationship, and that concentrated industries actually dampen inflation when inflationary pressures are higher. And I'd like to maybe focus on sort of the supply chain piece that Julie raised, right? So there's this claim that, yes, there's supply chain problems, but if markets were less concentrated, then they would be less fragile and better able to respond to these disruptions. So, you know, there's been a few studies recently suggesting concentration might be contributing to inflation. So, for example, from the Boston Fed, the Economic Policy Institute, and most recently last week from the Roosevelt Institute. But then there's other research from folks like Jose Hazar and his co-authors, which suggests that that might not actually be the case. So Chris, how do industrial organization economists think about this issue? So what does more recent economic research tell us about the relationship between concentration and inflation? And are these findings consistent from sort of the stories that were being told back in the 1970s?
Yeah, okay. So yeah, there's kind of two separate questions there. So let me start with like how did people do this in the 1970s? The bad old days, as we like to say, for industrial organization. So what people were doing was they were looking at mostly at prices or accounting measures of profit. So they would, you get a financial filing from a firm or from the census and things like that, and you would see something like, I see the firm's revenue, I see some measure of the firm's cost of goods sold or total costs or something like average costs. And I would try to compute a markup for a firm. And then I would look across industries usually, and I would try to figure out if profits or prices were higher in industries that were more or less concentrated. Um, and the idea at the time, what scholars were looking for was to find like the critical level of concentration above which we had to like really crack down on antitrust enforcement. And to say that the literature kind of failed would be an understatement, right? And it's not that concentration is good or that we shouldn't have antitrust enforcement. It's just that like as an empirical strategy, this like research program persisted through the 60s and 70s, and kind of the result when the obit was written in the 80s of this literature was that there was no agreement and everyone found every possible sign of every possible effect. That was like, if I looked at the relationship between prices and concentration across industries, the correlation could be positive and significant. It could be negative and significant once I included like the share of the firm whose prices or profits I was looking at. And so you had folks on one side saying like, look, there's this strong relationship between prices and concentration. And then you had folks at the University of Chicago saying, well, if I put in the shares of the firms, actually the relationship between prices and concentration is negative, and it's all efficiencies, and so we shouldn't do antitrust enforcement at all. And I think that we kind of reached an impasse as a literature. And I think part of the problem was that, look, like concentration itself is really hard to measure, and it probably actually doesn't tell us what we want to know, right? Like it tells us a lot about how markets look, right? The number of firms, the size of the firms in the market, that's all well and good. But what we want to know and what we've moved on to in the 40 years since then is how markets work, right? How they're organized and how competition actually works. We have it's not like everybody was a fool in 1970. We have much better data today and ability to measure stuff than we did back then. So let me kind of dive into, I think, what are the kind of the main sort of, I think, the studies people have seen a lot that have gotten a lot of headlines and are underlying sort of this, what I'll call the greedflation narrative. And so there's this study by EPI, and if you've seen it, it says something like higher profits are responsible for like 50 or 60% of the rise in inflation. And again, what did they do? They're using kind of these accounting type measures of profitability. And I think, there are reasons I think economists like me sort of don't trust them as much. And I think one challenge is when we think like when a firm is setting the price, the thing we think matters the most is the marginal cost, is the cost of that last unit of production. And the average costs can sometimes give us something that's close to a marginal cost for some kinds of industries and in some kinds of markets, but a lot of times it can't. And so what they did is they just took the sort of, you could think about like, they went to the Bureau of Economic Analysis, puts out these tables of national income and product accounts, which I'm sure Julie has seen before. And, they have something like the price of a good in the economy, of like, if there were one good for the economy, what is this unitized price? And they have something like the input costs for that good. And they have something like the labor costs for that good. And what the EPI exercise did is they said, look, if I start my data at the second quarter of 2020, right? So kind of like the bottom of, everything in lockdowns, when the whole economy was shut down, when workers were not, 20 million people were out of work, you know, when nobody could go to the store. If we start there and we look at the change in profits between that and the end of 2021, and we look at the change in prices between the end of 2021, and we just divide one number by the other, you would get that 54%. Now, there's a lot of reasons I wouldn't do that calculation. One is 20 million people were out of work when you started counting. And so if you just change that date, you can kind of get whatever number you want. But the other thing that matters a lot is that if you actually just start adding more data from 2022, from the end of 2021 and 2022, even if you follow the same script for that study, that those numbers disappear. And so if you look at the last 3 quarters, what's happening, right, is that, back in 2021, in that first quarter of 2021, what did we see in the data? We saw that revenues were super high, right? Everybody, what happened is, like, you get your shot, you go out to the store, you try to buy everything that you go to remodel your kitchen, right? You're buying appliances, you're buying all these durable goods, you're buying cars, right? You go to the dealer, and the dealer says, look, 2 years ago, I would have cut $4,000 off the sticker price for this car. There's no way I'm doing that now. There's a waiting list of people who will pay above sticker, right? And the reason there was a waiting list of people paying above sticker was the dealer knew he wasn't getting more cars in next month, right? There were supply chain shortages. There weren't enough microchips to go around. And so what we saw prices rise. Now, part of what I would say is I think what we saw also then is that meant there was a big change in the marginal cost, right? If you were Ford or the Ford dealer or the appliance salesman, your cost of getting another refrigerator or truck in stock was very high. It might have been infinite, right, for a lot of these firms. And so this average cost measure doesn't work so well. I think that's sort of part of the problem. But if you just redid the exercise, what then starts to happen is that revenues go way up in early 2021. Demand is strong, supply is constrained. And so we see profits go up temporarily really high. I think a lot of that is actually an artifact of the fact that what we don't see rising in early 2021 were costs. And there's a question when we use these accounting costs, why not? Right? And one possibility is the actual cost you're paying for, another thing to put on your shelf weren't going up yet. But the other story was those costs were actually going up. You just couldn't get enough stuff in stock, right? And when we're using these average costs, what we're not doing is none of these things are controlling for inventories. And so we don't have good measures of inventories, but a likely story was we were just spending down these inventories. So your revenues look great in early 2021 and your costs look low because you simply can't put new products on the shelves. And so you're not booking those costs yet. And so if you look at what happens in the EPI study, if you just extend their data out, you would see profits. What would be the profit contribution starting in Q2 of 2021 to today? It would be minus 5%. So instead of it being 50%, it would be minus 5. And so what's happened, right, is like in the late end of 2021 and certainly in 2022, what we're seeing companies' costs are rising more quickly than their revenues now. Revenues are still going up, demand is strong, but costs are catching up. And we don't know, right? We don't have the great breakout here. We don't know if it's that like supply chains are catching up and they're restocking, right? And we're seeing big changes in inventories, or if it's literally just they're paying more for all these inputs. So that's, I think, a puzzle. And we see, if you look at the Roosevelt study that came out last week, they're using pretty much the same, they're using a different measure of revenues and costs of goods, but they're using the same things. And they're just looking at the ratio for large publicly traded firms. They're looking at the ratio between revenues and costs of goods. And what they say again, if you stop your data in mid 2021, right, you would say, wow, revenues went up a ton in by the middle of 2021, and costs are not going up as quickly. And I think that's what they're picking up. And then you see all these companies go out and report record profits in like the second quarter of 2021 when stuff is flying off the shelves. And today, of course, what do you see when companies are reporting earnings? If you go to Walmart and Target and Ford and GM and all these big firms, and you ask them like, well, how are your revenues? And, how did Q1 2022, revenues look? Revenues look pretty good. Revenues are still rising. Costs are going through the roof. profits are down, profit margins are down, and so the costs are really catching up to these firms. And so I think a lot of what we're doing is like, if you extend these studies, and we'll know in a few months when we get another quarter of data, I think a lot of this stuff we saw about profits, record profits in 2021, and of course CEOs are bragging on earnings calls about record profits. That's what they're paid to do. That's how they get bonuses. That's they want to cash in those stock options. Yeah, of course this is what we were seeing, but I think this is going to be this like weird temporary blip where we saw a lot of demand for durables that was stored up from the past, show up. We see a lot of demand for durables get pulled forward, right? And then we just saw empty shelves, and so the companies looked like they had these sort of artificially low costs, and now you see costs are really catching up to firms. And if you ask firms like, hey, do you want to live in a high inflationary environment? CEOs will not say yes, right? Nobody is out there saying like, yeah, inflation is really good for our business. Everybody hates inflation, right? It makes it complicated. You have to negotiate contracts with suppliers, and all that stuff becomes much more difficult and much riskier, right? And so I think that would be kind of the story I would tell. I think there is this story like, did the firms sort of see the whites in the eyes of inflation a little bit faster than everybody else? Or did they just realize like, hey, look, if I don't raise the price, I'm not going to have anything to sell you tomorrow, so I might as well raise my price? Or is it like they actually were able to anticipate things a little bit better? That's, I think, a little bit harder to say. But yeah, I mean, the other thing is if you look at if you look into the Roosevelt study, and you ask like, where are markups super strong? What was the industry where the markups, as measured by revenue over costs, where did they look the best in mid 2021? And, you're like, oh, it's got to be, durables or, poultry manufacturing or, retail or something like that. No. By far, by a ton, it was financial services. And so, that's always not good. You usually throw that out when you're doing these calculations because financial services are driven by all kinds of things that we mostly don't understand.
That's helpful, Chris. It sounds like there's a lot of measurement difficulties here that make it really hard to say anything definitive about sort of that relationship between those profits or markups and inflation. And, another one that comes to mind to me that gets thrown around a lot is this narrative that concentration in the economy is increasing. And then, when you sort of dive into the details, they're measuring or they're defining markets by 3-digit NAICS codes, which are like these really broad sectors of the economy. I don't know if you could talk a little bit like sort of like about that measurement problem in some of these studies.
Yeah, I think we say like, look, like, I mean, Julie worked at the FTC, so concentration in a well-defined market is super hard to measure, right? Like what we know in the US is like, you look at supermarket retailing at the national level has gotten much more concentrated in the past 4 years. At the local level, but you don't drive to California if you live in New York to go buy things at the supermarket, right? So the fact that there are these national chains isn't really what matters. What matters is that now, instead of sort of one supermarket, I might also have a Walmart and a Target or a Costco and some online option at which to shop for. And so it's kind of very hard to get what is concentration in a kind of well-defined market. I think the thing we absolutely know not to do is do what I think some of these studies have done, which is you don't want to look at concentration using only the set of US listed public firms, right? And you don't want to do it, you want a sort of a product market. So you don't want to just look at like the revenue shares of US listed public firms in mining, right? Which is like the level of like a 2-digit NAICS code. It's like, well, what are you mining? Well, they're not all competitors, right? And so we want to not do stuff like that because I think it tells a misleading story, right? The other problem, of course, is that a lot of these studies, this CompuStat data, it's very easy to download. Anyone can get it, but it's only publicly listed US firms. And so that means like changes in concentration over time are within an industry are often driven by weird stuff. Like, does Anheuser-Busch get bought by a European headquartered, InBev? Yes. does that reduce concentration in the US market? No, that was a merger, right? It increased concentration for sure. If we look at publicly traded data, we might actually get the wrong sign, right? The same thing, like we saw a lot of tax inversions at various points, in the last couple decades. When a US firm gets bought by a Canadian firm for tax reasons, again, that didn't take a firm out of the market. The firm is still there. They're still producing. If a firm gets bought by private equity, they drop out of that data set. It's not that they don't exist anymore. It's that they're not measuring them. And so you have to be really careful to actually measure concentration, for the relevant industry. But yeah, I think the other thing you kind of asked was like, what's the relationship between concentration and sort of pass through of shocks, and what do we know? And I think what we know is in a competitive market where costs are flat, right, where there's no upward slope to costs, we know that we expect 100% of costs to get passed on into prices. Why? Because if you're pricing at cost, if your cost goes up, you got to raise your price by the same amount. What we've usually found in the literature going back the last 30 or 40 years is that when firms have market power, when their prices are above their costs, what do? They will often reduce their markup when they get hit with a cost shock so as not to raise their price too much, right? They trade off both, I can adjust my markup a little bit because I don't want my demand to fall, right? But I will also pass on some of that as a higher price. And I think that is like a pretty robust finding. I've actually worked on a case where it's the opposite, where you get more than 100%, but those are super rare, and that's why they're interesting enough to write papers about.
That's a great point to raise, and kind of segues into the next question that I wanted to ask. So, this populist approach to antitrust enforcement that we're seeing now, that's being advocated by current leadership at the Antitrust Division and at the FTC and by President Biden, is a real departure from this usual focus on consumer welfare. So the populists are focused on limiting firm size, protecting competitors, limiting layoffs and mergers, are pretty hostile to vertical integration, as I mentioned at the beginning. Biden directing the FTC and the USDA to investigate claims of price gouging. So, Rob, I wanted to turn to you. Is this new direction for antitrust likely to have any impact on inflation? And sort of maybe hinted at by Chris, like, could this make inflation worse?
Well, let me just say very briefly, as Undersecretary, I oversaw both the Census Bureau and the Bureau of Economic Analysis that collect all the data. And I just want to say, look, there is all you have to do is track the revisions in the data to understand that there are a lot of constraints, particularly on current data. At the same time, the BEA has 2,000 economists who do nothing but try to get this right. And they do it at a level of detail and care that is totally lost when they publish the data. So I'll also say the BEA is one of the very few agencies in the entire government which has no political appointees, zero. They are all professionals. You can't say that about the Census Bureau. And frankly, the results of the last census showed the ways that political interference undermines the collection of accurate data. That was my little spiel on the data. Certainly, as inflation is heated up, we're hearing a lot of criticism of large market shares, industry concentration, vertically integrated companies. I agree with Chris. I think market share is probably a better way to get at these issues than concentration myself. But, and to be sure, there is a serious debate among academic antitrust experts about whether the current focus of antitrust enforcement on prices as the core of consumer welfare, regardless of market share, is too narrow. That focus, incidentally, originated in the last major round of academic debate over the terms of antitrust, 40 or 50 years ago. And we should also recognize that most economists generally agree, I think, that a large market share does not necessarily impair competition so long as their companies don't use their large resources to unfairly disadvantage their competitors. As for inflation, as Chris has said, there is, in my reading, very little economic basis for the case that firms with large market share are taking advantage of the current inflation to raise prices further. The argument, frankly, has become a kind of political clickbait. I suspect to channel people's unhappiness over inflation to certain industries and companies. And it's not surprising that the studies have come from two of the more politically oriented research institutes, EPI and the Roosevelt Institute, as opposed to the National Bureau of Economic Research. Ironically, if companies with large market share were taking advantage of the inflation to raise their prices, it might well argue for and not against the case for measuring the impact of market share on consumer welfare predominantly through prices, which is not the intention of those making that case. But the argument is very peculiar because it assumes that companies with large market shares waited for the current inflationary environment to extract unfair profits, when the incentives to do so, if they could, are unrelated to that environment. Why didn't they do it in 2018 or 2019 when the public and political response would have been more muted? Moreover, the data do indicate, at least in my reading, that the large market shares of companies in certain industries has not promoted inflation. Despite claims to the contrary, there's just no credible evidence of U.S. meatpackers or oil producers using their domestic market shares to extract higher non-market-based prices. And under certain conditions, an antitrust approach hostile to companies with large market shares could certainly exacerbate higher prices. To see how, we go back to the very basics. Markets depend on consumers and business customers responding to prices and price changes, and how much they do so is measured by what all of us would call elasticity of demand. Those responses don't depend on a company's market share, but on how much customers need the good or service and whether they're acceptable substitutes that cost less. That's how markets work. Now, many things inform these responses. Some people prefer dominant brands and they'll pay more for them. That's not price gouging. It's those people see value in paying for the certainty that a brand will deliver what it says and what they expect. We see a similar dynamic in the organics industry. People choose to pay more because they value the assurance that, for example, a product hasn't been treated with pesticides. There's also a lot of evidence that a company's large market share can produce substantial benefits. This is distinct from the argument about industry concentration. This is focused on market share. Consider banking. And this is a very well-known study that I'm sure Chris, Julie, that both of the Julies here are familiar with. Large banks are more stable. They can better diversify their holdings. They earn higher profits. They take fewer risks. To achieve comparable stability with a much smaller market share would require measures that directly raise the prices of those banking services for borrowers, depositors, and others who use them. So going after companies based simply on market share could, under certain conditions, lead to higher prices. More generally, as a company's market share increases, its returns on investment rise, because studies show that large market share also tends to raise profit margins, lower a company's purchases to sale ratio, reduce its marketing costs as a share of revenues. That's how economies of scale work. Capping a company's market share could reduce those returns on investment, lower its profit margins, increase its purchases to sale ratio, and raise marketing costs as a share of revenues. That is, everything else held constant. That also suggests that operating at a smaller scale may require higher prices, and mandating similar size could worsen inflation. This is why new companies depend on innovation, frankly, because they can't match the economies of scale. They can't match the customer bases. They cannot match the underlying advantages that large established companies have. And so they have to, in effect, go around them by producing an argument that will make sense to consumers, that they'll get more for the product, because the product is different or the service is different in some discernible way. Now, I'm going to get into a little controversy here about the causes of this inflation. This logic doesn't hold for monopolies or cartels, especially when they produce products with few substitutes and low elasticities of demand, such as oil. We know that OPEC's government-owned or government-managed oil producers periodically conspire to set prices by managing their production, led by the largest marginal producer, Saudi Arabia. Moreover, we can see that the production, while it increased from the depressed levels of 2020, did not return to the levels of 2018 and 2019. That's a constraint on supply. First, when we get to the inflation, and I'm going to argue that energy is a very important factor in this. Let's dispose of the argument by my old classmate, Larry Summers, that the Biden plan is responsible. Inflation began to accelerate in March 2021. The Biden plan went into effect in March 2021. We know that there are substantial lags between fiscal policy changes and the impact on prices. There is no way in this market economy that the Biden plan was driving the onset of inflation or the inflation through 2021, frankly, unless there's a new economics. Let's now look at the actual inflation data. Now, I measure it since March 2021 because that's where I see the acceleration really taking off. And since then, overall prices have risen about 10% from March 2021 to May of 2022. Prices for energy commodities have gone up 61%. Fuel oil prices have gone up 104%. Gasoline prices have gone up 45%. The data also show that inflation is much greater in industries dominated not by companies with large market shares, but based on whether the good or service requires a lot of energy to produce and transport. So big, heavy things, their prices are going up more. Prices of cars and trucks are up 13.2%. Prices of major appliances, 9.3%. Food prices up 11%. Now think of some goods that use very little energy to produce or ship, like prescription drugs. Remember when inflation was being driven by healthcare. Prescription drugs have gone up 2% from March 2021 to May 2022. Eyeglasses, they're up 2.2%. We see the same thing in services. The prices of services that use a lot of energy, such as transportation or recreation, have risen several times as much as those in less energy intensive areas, such as doctor and dentist services, which are up about 2%. College tuitions, which have been rising over the last 30 years at a multiple of inflation, they're up 3% over that period. And finally, let's consider two industries that are among the economy's most highly concentrated or are dominated by a small number of companies with very large market share: wireless service and internet services. They've seen virtually no inflation, literally no inflation in the last 15 months. I do want to also endorse or agree with Chris's remark about inventories. You know, part of what we are seeing is a supply phenomenon apart from the cartelized supply constraints on oil, more generally across the economy. And that's, you know, normally when the economy is growing strongly, inventories rise. You look at 2021 and inventories contracted. Now, why did they contract? They've been burned in 2020 because they couldn't sell as much as they could before. And let's remember that there was the Omicron variant that begins in 2021. And, you know, just as, you know, we need to keep in mind that all of these phenomena are happening within the context of a black swan event. This is not normal markets, because businesses and consumers have been shocked. Multiple shocks. We saw this with consumers in particular in saving behavior. You know, saving rates went to World War II levels, literally, and were 2.5 to 3 times as high over a fairly sustained period. That's indeed why we needed the relief plans passed in April 2020 and in December 2021, because given the saving rate, had we not, which people were going to do regardless, because this was all precautionary saving. People were terrified they were going to lose their jobs or die because there were no vaccines, and they'd lose their houses. And so they began saving at the rates that Chinese save because they have no health care coverage or retirement plans. Again, precautionary saving. In the absence of those relief programs, we would have been in a depression. And even when we think about the Biden plan, you know, the Biden plan may have created some support for the inflation in 2022. It also created 6.5 million jobs that produced the demand. It again was an attempt to try to deal with the shocks of a black swan event. And, you know, ultimately, as I see it, the inflation is being driven substantially by OPEC's response to that black swan event, which of course enormously depressed its revenues in 2020.
That's helpful perspective, Rob. I just want to remind folks that if you do want to ask a question of our panelists, we have just a few minutes left. You can do that at slido.com using the hashtag ITIF Antitrust. I want to key into something that you said, Rob, about the low or zero inflation in wireless and maybe turn to sort of the digital economy more generally. So, and I'll just open this up to whomever. So like, how do these goods, which typically not just have sort of are not inflationary, but tend to have declining prices, how do they get incorporated into inflation measures? And then, there are these current legislative proposals. The one in the news a lot lately is Senator Klobuchar's American Innovation Choice Online Act, which wants to sort of limit conduct by technology platforms. How do we think sort of some of these sort of regulatory measures might impact inflation for digital goods? Just throw that open to whomever.
Well, I'll just say very briefly, there are two debates here. One is about concentration and market share. The data are very clear, frankly, and in particular, and that we have not seen inflation arising in these sectors in this period. And let me say, the BEA works very hard to try to adjust the prices of digital services for quality improvements, because it's an industry that experiences continuing quality improvements, which is unusual among industries, but they're always lagging behind. That's necessarily the case. And to say, I saw the first time they did it was when I was undersecretary, and it was enormously complicated. There is no single or two or three or four measures that you can apply to try to figure this out. The other debate about in particular internet services or social media platforms in particular is not primarily an economic debate, but a political debate. And it doesn't really, certainly if you limit the revenues of a company, of a social media company, through restrictions on, through changes in liability, for example, that create incentives. There's a legislation in California that characterizes the response of children to social media as addictive behavior. It medicalizes it, and consequently proposes various restrictions. If you limit, in effect, the market of these companies, you will certainly reduce their revenues, and they will do what they can to maintain their return on investment, and that may come out in higher prices to advertisers, which in turn produces higher prices for consumers. In those cases, what you're doing is, the argument is a different kind of argument. It's a trade-off of social effects versus economic effects. But the economic effects are pretty straightforward.
So we've got about a minute left. Any last thoughts from anyone?
Sure. Can I jump in?
Yeah, go ahead.
Yeah,
Chris.
I think I would just say, like, I think the things we want to, with the legislation we're seeing today, I think one of the things that makes me a little bit nervous is that, well, we want, rules and laws that promote competition, particularly among these platforms. I think I worry some of these rules and laws may be trying to protect the profits of incumbents, right? So like, we want Yelp to go out there and invest in better reviews and search. We don't want Yelp to win simply because Google can't show their listings for pizza places near me, right? And the same thing, like I want Amazon to be able, it's okay, I'm probably not losing that much sleep if Amazon shows me like Amazon originals with Miss Maisel and they look at data and say people really like this and they're going to make more Miss Maisel episodes. But it's very strange to think about a world where some of these firms are prevented from doing these actions, like promoting their own shows or having exclusive content, and larger competitors like Netflix or Spotify are not subjected to the same rules, right? And I think I'm a little nervous when you see the competitor firms really cheering on the regulations that only apply to their rivals and not to themselves. And so I would say, if these are good rules, maybe everybody should play by them. Otherwise, maybe this is just a way to shift surplus around, right? And I think that's what we have to be cautious of.
Well said, Chris. Julie, anything from you?
I was just going to go back to inflation for 1 minute and just say I agree with Rob said, like, inflation is very complicated, and the BEA and the BLS do a fantastic job getting us these measures every month. But they are constructed by humans, and we're making choices on how to construct them. And I think it's important for people to realize that and understand that also that their inflation experience may not be fully reflected in what sort of the aggregate number is because of their household circumstances as well. But I'm very happy that we have people on the job doing such a fantastic job getting us these statistics every month, so we can think about them all.
Well, it's been really great, and thank you everyone for taking the time this morning to have this conversation. Thanks again.
Thank you.